Hedge funds, private investment funds, investment advisors, and similar financial service industry firms may have heard of trade error insurance, which is also called cost of corrections insurance. In this video, I'm going to explain what it is, why it's needed, and how to get it, coming right up. Hi, I'm Gordon Coyle. Before I jump right into cost of corrections insurance, can I please ask you to hit that like button? That'll signal to YouTube that this is good content and it'll help my channel grow. Thanks. So, cost of corrections or trade error coverage. What is it? This coverage is an endorsement to a D&O E&O policy for a financial services firm, such as a hedge fund, a private investment fund, or a registered investment advisor. The endorsement covers the cost that an investment professional incurs to mitigate or correct the direct damages to an investor that arises from a trade error. A trade error is broadly described as a securities trade that was executed incorrectly by the insured professional. It could be triggered by purchasing or selling a security other than what was specified by written order, or executing the wrong quantity of shares or dollar amounts, or trading on the opposite side of the market than what was ordered. The key intent of cost of correction coverage is, of course, to fix the problem trade and to make the investor whole. But from the insurance company's perspective, it's also there to help avoid a more costly lawsuit that may claim greater damages and incur legal fees and end up costing the insurance company more money. Now, cost of corrections trade error coverage does not exist to pick up after sloppy business practices. In fact, most of these coverage endorsements carry a fairly high retention, which is similar to a deductible of $150,000 or more. If a claim occurs, you're forking over the first $150,000 and your insurance company kicks in up to the limit of coverage, which can be $250,000 to $1 million or more, depending on the size of your fund and the limit you select for your core D&O E&O coverage. Now one last point. The window to report a claim and be considered by your insurer is relatively short, usually around 15 days. That means if you incur a trade error, you need to notify your insurance company quickly and provide them the details as to what transpired. Failing to report this within the prescribed window stated in the policy can result in a declination, something of course you want to avoid at all costs. Have other questions on cost of corrections, trade error insurance, or about D&O, E&O, crime, cyber, or other coverages commonly carried by financial service firms? Give me a call or drop me an email. My contact info and a link to my calendar is below where you can book a time that works for you. I promise when we connect, no hardcore selling or gimmicks or nonsense, just some conversations where I can answer your questions and give you the peace of mind you're looking for. Thanks.